Welcome back, everybody. So today we are going to be talking about the stock markets and everything else in between. Now, over the past couple of days, I probably received well in excess of about 800 messages on Instagram just in relation to the stock markets, the bond markets, and my overall thesis. Now, a lot of these comments have been incredibly negative, and I can kind of understand why. But I want to give some insights in terms of how I am currently assessing the markets. And now I thought what would be quite a good exercise to do is to unpack this from a bull perspective, a bear perspective, and then kind of give you my overall assessment on where we're currently at. Now, from a bull perspective, things are looking incredibly juicy at the moment because we basically have a new trade deal with China, well, the US and China. And what kind of gives a lot of investors a lot of clarity, they feel a lot more relieved just in relation to where things are currently going to be from a tariff perspective. And a lot of people are buying back into the stock markets because this has basically been addressed. Now, also, there's a lot of anticipation that the Fed is going to be cutting interest rates, what basically implies that risk is back on, meaning that crypto is going to go back up, meme coins are going to go back up, all of the stock market is going to go back up, etc., etc., etc. And obviously there's a lot of excitement. Now, the deal yesterday with Saudi Arabia is going to be investing a significant amount of money in the US. A lot of bulls are very, very, very happy with all of this news because it gives clarity. People can kind of see where things are currently going. Now, from a bear perspective, a lot of bears are basically saying that this China and US trade deal is only for 90 days. It doesn't really address a lot of the longer term implications. Bears are also talking about how the unemployment rate is going up. They're also discussing how the yields on the 10, 20, 30 year and basically all duration is basically going up, not necessarily just in the US, but across all credit markets. And they're also kind of highlighting a lot of delinquencies from a credit card perspective. Now, I was sent this chart from somebody on Instagram. I'll put it on the screen now, but this kind of highlights a lot of delinquencies in credit cards, meaning that a lot of people are struggling to pay their bills. And obviously with the cost of credit going up, that is just going to accelerate that trend because obviously the cost of capital, the cost of credit is going to be even more expensive if the 10, 20, 30 year yields are going to keep going up significantly. So now obviously there is a significant amount of positive news and a significant amount of negative news, and a lot of people are trying to figure out where the stock market is going to go. Now, with the market being down significantly just within a couple of days, you would kind of expect let's say a rally off the lows, and this rally has been incredibly violent. Because as you can probably imagine, a lot of people go heavily short, and as a result, as the market starts to tick up, these shorts are squeezed on their short positions, meaning that they are forced to buy, what basically would drive up the stock markets even more. Now, obviously, bulls are making a lot of money because of this short selling, and also you have something called gamma squeezes as well, what kind of implies that a lot of people who are bearish would be forced to buy, what again drives up the stock markets. And there's a lot of bears who are significantly upset with the overall price movement. Now, my overall assessment of all of this is I still think that we still have systemic stress in the financial institutions in Asia, in Europe, and obviously in the United States. And I don't think that the stock market obviously rallying off the lows 20% basically addresses these underlying systemic problems. What basically is addressing the long end of the yield curve. And I know I've addressed this before, but if the Fed cuts rates, that doesn't look like strength, that looks like weakness. And when the Fed typically cuts, they don't control the long end of the yield curve, meaning that they only control the short end duration. So the 10, 20, 30 year money, the interest on that money is set by the market. Now, with the Fed basically staying strong and not necessarily cutting too soon, they are basically inflicting a lot of financial stress in a lot of different countries. I mean, you can see this in Argentina, you can see this in China, you can see this in Turkey. You can basically see this all around the world in all of these different types of markets and currency pairs. And just because these tariffs between the US and China has kind of been semi-addressed, I don't think it really fundamentally addresses the long end of the yield curve. Now, just addressing the long end of the yield curve, the reason why the yields go up is because a lot of these countries are forced to sell their assets. Now, as their currency, let's say, starts to strengthen, you see China basically step in and liquidate some of their assets. And their assets can be gold, Bitcoin, treasuries, or whatever, to basically stabilize a lot of their internal problems. Now, when we see the Chinese and the US dollar basically get to about 7.35, we see a lot of intervention from China, basically selling a lot of their assets. And you can kind of correlate this with different types of charts, meaning the gold price, obviously NASDAQ, etc. You can start to see a lot of these correlations where governments basically intervene and sell something to basically prop up a lot of their internal systems. Now, I've basically been talking about how we see a significant amount of stress in China just in relation to the CNY, CNH spread. And when this spread starts to break out, we see a lot of intervention from the Chinese government basically selling, whatever they can to basically stabilize their own economy. Now, over the past couple of weeks, we have seen that spread elevate about 8%, and then they are forced to sell something, what obviously brings that spread down. And last week, we saw that spread elevate again, up to about 5%. They intervened again to bring that down. Now, over the past couple of days, with the stock market rallying significantly and everything else pretty much rallying, that spread is significantly elevated. And it wouldn't surprise me that if we saw that China would be forced to sell either treasuries, anything in the stock market, or gold or whatever. And I've kind of been highlighting this over the past couple of weeks. Like, China holds a significant amount of gold, and I would anticipate them selling some of that gold to basically stabilize a lot of their internal economies. Now, again, just because we have this trade deal doesn't necessarily mean that all these problems have magically gone away. And obviously, I fully understand it, why a lot of people are very, very excited about the prospects of going back to an all-time high, where I am kind of talking about a lot of, let's say, macroeconomic stress in different types of financial sectors. Now, I was kind of highlighting in my previous video that I thought that the escalation, or the significant escalation between India and Pakistan, was incredibly fascinating. We saw that escalate quickly. And like I was saying, over the past couple of weeks, we have seen this spread between the currency what is inside China and the currency what is outside of China, again, get elevated, and they are forced to sell, they are forced to sell, they are forced to sell. Now, what I've been talking about is just the implication of different types of media outlets on different types of, let's say, applications. And obviously you've got TikTok, a lot of people in Pakistan kind of use, and you have Instagram, what a lot of people in India use. TikTok is currently banned in India. And this escalation happened so quickly, and I was kind of, I'm kind of drawing the lines together, what would basically say that, there's a lot of good reason of why China would want this escalation to happen so quickly, because a lot of people are trying to move their manufacturing outside of China to India. Now, obviously, as a result, you are seeing a lot of financial stress. There's been a lot of people who've basically been saying to me, well, you can't talk about India and Pakistan in that way. We are not necessarily in Chinese or US pockets. And what I would say is how ironic it is that we've seen a ceasefire and then we've instantly seen a deal from China 24 hours later, basically saying, oh yeah, well, we've got a pause on trade tariffs for the next 90 days. I mean, how ironic. And the reason why I think it is very, very ironic is because the US cannot afford for more escalations from a military perspective, because the military spending is significantly elevated as it is. And at the moment, we can see that the interest on the national debt is exceeding the military spending. And obviously getting into another war, what would basically imply that the US is going into a debt spiral. So again, they cannot allow that to happen. And this is why I think that this trade deal has basically come about so quickly, is because of the escalation between India and Pakistan has basically come about. Now, again, a lot of people are basically going to disagree with me, basically saying, well, that is not the case, blah, 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 blah. But I really do think it is the case. And if I was the administration, I would do the exact same thing. Because, again, you cannot afford for that escalation to escalate even more, because it's going to cost you so much cash, and you are in a vulnerable position anyway. Now, you're obviously going to package together some type of deal for China and obviously India and Pakistan, and basically de-escalate that entire thing. Because again, you cannot afford for that to escalate. So again, if I'm the administration, I would have done the exact same thing, because you can't afford it. You basically can't afford it. Now, there's a lot of people who are basically saying that the administration have basically caved in to the Chinese tariff escalations. And I can kind of understand it. But again, you can't afford for India and Pakistan to basically have a full-out war when you have the Ukraine and Russia escalation, when you also have the Chinese tariff wars, etc., etc. There's too much at stake and things would bleed significantly. So what else do you kind of propose? Because if you don't propose a deal, things would just escalate even more. You would have a lot of, let's say, military risk rather than just financial risk. I think a lot of this tariff talks and deals is as a result of what has been going on in India and Pakistan. And, you know, the US is kind of forced to kind of put some type of deal together because, you know, they don't have any other choice. There is still significant amount of stress in the Chinese markets. Not necessarily China and all these other different types of neighboring countries. And like I was saying in my previous videos, I have been in Malaysia for the past couple of days to basically build out relationships with lenders. From a credit perspective, I've been talking to a lot of real estate agents as well, and a few different types of hedge funds who are basically trading in Asia, as well as the US, etc., etc., etc. Now, what is incredibly interesting is that there is basically no buyers in these markets. And the reason for that is because the access to credit, the access to lending is basically drying up, and sellers are not necessarily willing to drop their prices. And as a result, you have a stagnant market. Now, a lot of real estate agents are basically anticipating that once these trade tariffs are over, and there's a lot of, let's say, clarity going forward, that a lot of this market is going to come back. But what I would just say is that what happens if that doesn't happen? And what happens if that credit risk does not get addressed? Because that is going to have large implications on Malaysia, on Vietnam, on Thailand. I am speaking to people on the ground in relation to the property market, in relation to credit lending, and they are basically all saying that this market is incredibly, incredibly difficult and things are definitely moving. As I'm talking to these people, I'm basically saying, what are you most optimistic about the Malaysian property market for the next 3 to 6 months or the next 12 months? And you know what? A lot of them are just wanting to sell their properties. A lot of people don't have access to credit. A majority of investors in Malaysia are Chinese. And a lot of these Chinese investors don't really have access to credit. So you have a lot of uncertainty in these markets, what is having an effect on buying, purchasing, and ultimately asset prices. So what I would say to bulls is basically that we still see a lot of stress. Now, this stress has not significantly gone away because we have some type of trade deal and Microsoft have basically released a great quarter and that we are going back to all-time highs. We could have a lot of momentum. We can see a lot of gamma squeezes, short squeezes, etc., 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 what can kind of push us up to all-time highs. There's still a lot of stress in these markets and people are not really paying attention to it. And go back to what I was saying earlier, just in relation to the long end of the yield curve. Now, I do think that these yields will be coming down sooner rather than later, just because of the refinancing issues on the national debt. Now, I also want to address just in relation to the invalidation of this entire thesis. Now, granted, the stock market is up, but the amount of stress in China is significantly elevated as well. I think it would basically be invalid when we see the credit risk in China basically come down. And at the moment, I don't think that is going to happen anytime soon. And, you know, there's a lot of emotion, there's a lot of momentum in the stock markets at the moment, just in relation to going back to all-time highs. And we start to see the yields on the bonds to come down as well, what would basically imply that bonds need to go up. And how do bonds go up? Bonds go up when a lot of people are basically scared into the treasury market. Now, another possibility is that the US could put some type of trade deal together with another country, and that part of that deal is that they have to buy US treasuries. Now, I could kind of see that playing out depending on how much leverage the US currently has. And, you know, there's a lot of other different types of moving parts, right? I mean, how it becomes invalid. I'm struggling to kind of see how this becomes invalid if the yields keep going up and if the stress in the Asian markets keeps getting more and more elevated. Because again, I just see it as an elastic band. You can stretch this elastic band as much as possible, but as soon as that elastic band snaps, that snap, everyone goes back to US treasuries. This whole snap analogy is basically forced liquidations across all different types of asset classes. And the reason why I'm anticipating gold to go down or even Bitcoin to go down is because China would be forced to sell some of these assets. And again, they would be forced to sell gold, treasuries, Bitcoin, or whatever to stabilize their own markets and economies. And that's when you would see a large movement in the bond price, what would ultimately bring the yields down. And I think that is ultimately where they want to get to. Because like I was saying in my previous videos, Scott Bensont is a very, very, very good macroeconomics analyst. And he was part of Soros Fund, and he basically he understands currencies and he understands economic and financial stress. And I'm just putting myself in his position. He will be looking at a lot of these things. And again, I think he was kind of forced to get a deal with China done relatively quickly because of the escalations between Pakistan and India. And I still think that they are still going to be putting a lot of stress on China and a lot of these other countries, what would basically decouple a lot of these nations from China and make people go back to the United States. Now, the invalidation would basically be that if the stock market went to an all-time high and just kept on going up significantly, and the yield started to go up more, let's say to 6 to 7%. But again, I mean, 6 to 7% bonds is mental. So it would be basically Armageddon because nobody would be able to afford everything. Everything would just basically, there'd be so many people bankrupt. It would basically be absolutely insane, and a lot of people would basically go insolvent. So again, I just think it's a short-term rally, and I think it's kind of a bull trap, if I'm being completely honest. And I do think we are going back down to the lows. Like, what I am trying to assess is what is going to be the catalyst, what drives the market down. And what could be that catalyst is that if China or a lot of other nations, or Japan, for example, I mean, we're not even talking about Japan. I mean, Japan's 10-year yields are like, it's 1.6%, 1.7%. What again is mental, is in so much debt, significant amount of debt. And having these yields at like close to 2%, they cannot do it. They cannot have yields that high. If Japan is forced to sell US Treasury bills to basically stabilize their own economy, what that would mean for US Treasury market would be insane. So again, I think I just can't see themselves. I just can't see the administration with all the talent they have around them in relation to macroeconomics, why they would put themselves in such a stressful position when, when they could kind of use tariffs as a stick to get people back into the treasury market. I think China instigated the India and Pakistan escalation, what basically forced the US to come to the table with a trade deal. And obviously de-escalated that, what ultimately de-escalated that entire thing. So again, there's a lot of moving parts, but I would really like to hear your thoughts just in relation to what you believe could be a potential catalyst on the upside or on the downside. Because again, I think there's a lot more negative points than positive points. Because even if we do get a trade deal and tariffs, let's say, are at 10% or whatever, we still have to refinance 40% of the national debt at 4.5% interest rates. Because how are you going to do that? Because again, you do not have enough revenue to cover your expenses, what ultimately is the interest on the national debt. So again, like, how do you do it? And this is why I just keep thinking that this is a short-term rally and it's basically a bull trap and everyone goes aggressively long. And then ultimately the market gets pushed back down and a lot of these bulls are basically trapped. And again, you have a whipsaw motion, right? Like bulls and bears, it's very, very emotional. So yeah, I'm just trying to assess just in relation to the overall, let's say, sentiment, the overall catalyst, just in relation to where we could be potentially going from a stock market perspective and what that catalyst would be. Because for me, I cannot unsee the stress what I'm currently seeing in Asia, in credit markets, in the bond market, and everything else, what is currently going on in my DMs and everything else. And now, if you do have any comments, obviously your bull thesis or bear thesis, just in relation to what is currently happening, I would be greatly appreciated if you could leave that in the comment section down below. Now, hopefully this audio has been good, but to the 4 people who keep on supporting me, I hope you're having a lovely day and take care. Bye-bye.